2023, after a long absent period, Peter Lynch is back to an exclusive interview with CNBC about the current stage of the economy, what we should be looking at right now and how to make good investment decisions during this challenging period. So, let's look into this together. For those who may not know Peter Lynch, he is one of the best stock investors of all time. He was former manager of Magellan Fund, and during his 13 years of management, his fund performed an average of 29.3% annual return, more than twice of S&P 500 during that time.
Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever. You know, I never know when we're going to go. I'd love to know the future. I'd be a better investor. I'd pay $5 extra for next year's Wall Street Journal. It would really help. Right. I cannot predict the future, but this recession is so expected, so predicted. You know, it's nothing like, imagine 1980, 81, we had double-digit inflation, double-digit unemployment, and people worried the Japanese were going to take over the world. I mean, we were hopeless. I mean, you know, there's always something to worry about. I'd really, in my over 50 years of doing this, I think I'd be worried if there was, you know, somebody didn't bring up something to worry about.
What he means here is investment is looking forward to a much longer-term horizon. Look ahead of just what is going on with short-term period and invest in the companies you know well about their businesses and their values. Stick to our investing strategies in spite of the short-term macro situation. This short-term negative macro situation gives us the best opportunities to buy the companies that we like. He mentioned about 1980 to 1981 recession when the U.S. inflation was 15% and interest rate was 19% and unemployment was over 10%. We got over that period. So during 2022 to 2023 with inflation of max at 9% and interest rate near 5% while unemployment rate is very low. It is not that bad. So, as he also said, we have had 13 recessions and we got over it, so we will also get over this one too.
Is your sense, though, that the style of investing that you pioneered is still doable and winnable today?
Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop? So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, you know, Family Dollar stores. I'm not saying that buys now, but that's what's made our... You know, Sears is rolled over, so, you know, so Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt and no cash. Which one are you going to buy? I mean, that not too hard to do.
He mentioned about a very important aspect in investment is we have to look into companies with a strong financial position. So, under the economic challenging periods, we need to find and invest in companies with good balance sheet with healthy cash balance and lower debt level.
Look at Analog Devices, look at Teradyne, look at TJ Maxx, look at the turnaround of Target. I mean, you can see these companies coming. Look at Wingstop. I tried those wings. Wow. I'm not saying that buys now, but they're out there. Look for a company that's going to do well in the next few years, 5 years. Look at their balance sheet, or look at a turnaround. When companies go from crappy to semi-crappy, the stock goes up. When it goes from semi-crappy to good, they go up. When business gets to be terrific, get out.
In his book, One Up on Wall Street, he discussed about 6 different types of companies: fast growers, stalwarts, slow growers, cyclicals, turnarounds, and asset plays. So during the recession periods, companies that you should pay attention to are in the fast growth group where they have strong positions in financial state, or companies in the turnaround group that is coming out of the tunnel and seeing lights.
Wait till things get better. Some signs of things getting better. You have an edge. You might be in that industry where things are starting to improve. There's a lot of positive coming along. The price of oil has gone from over 100. It's now 80. 1 year out is 78. Natural gas has gone from $8 an MCF to $2.30. I mean, we've added over 6 million jobs in 21, 22, over 1 million jobs in the first quarter. A lot of people at the bottom part of the economy have had significant raises.
This positive thinking mentality is very important as an investor, and it is even more important during crisis times. As he said, you do not have to buy the stocks right away and right now. The things are you need to stay focused and know what you are doing. Do not get panic when other people get panic.
To be a good investor, from my own experience, following are the first important steps you need to do. 1. Prepare yourself by learning investment knowledge through reading investment, financial and accounting books from famous and successful investors. 2. Apply and practice your learning and find the best strategy that works for you. 3. Before you find the best strategy that you can make successful investment, diversify your investment portfolio and do not put all the eggs in one basket. Remember, no successes come without failures and pains. So training yourself to practice patience is very important. I hope you get some insights and learn something new from this video. Please subscribe my channel for more future videos.